Right, so today we are going to look at a question from business finance called Tufa Co. And if you look at what is asked of you, they're asking you, first of all, to calculate the after-tax weighted average cost of capital on market value basis. Then discuss circumstances under which it is appropriate to use the current work of Tufa Co in appraising an investment project, and advantages of using convertible loan notes as a source of long-term finance. So this is a quite nice question, all things considered. But of course, you need to know how to deal with such a question because it's a short question, and majority of the marks for this are got from calculation, so which is usually nice. So they are giving us information here about Tufa, which is a listed company and pays tax at 30%. So we have equity, they have given us its equity and liabilities, which have retained earnings and share capital. Then we have the assets and we have the non-current liabilities, which include the long-term borrowings, and then also have the current liabilities. So now they're telling us that the share capital of Tufa consists of 12 million ordinary shares and 5 million redeemable preference shares. Ordinary shares have a nominal value of 0.5 per share, an ex-dividend market price of 7.07 per share, and a common dividend market price of 7.52 per share. So we shall understand these two and see even how to deal with them. If you have gone through the classes, you should already know what this means. So dividends are paid in recent years as follows. So we have 0.43 in 2006 and so on. The 5% preference shares have a nominal value of 0.5 per share and an ex-dividend market price of 0.31 per share. And the long-term borrowings consist of 10 million of loan notes and 3 million bank loan. And the bank loan has a variable interest rate. The 7% loan notes have a nominal value of 100 per loan note and market value of 102 per loan note. And then annual interest has just been paid, and the loan notes are redeemable in 4 years' time at 5% premium to nominal value. So that's what has been given to us. Of course, now, if you have done a question on work, as we call it, you would know how to proceed with this. But if you haven't, then this is a good chance for you to understand how work works. So work is weighted average cost of capital. And basically, the reason why we say it's weighted average cost of capital is that normally a company will be financed by debt and equity. So each of these ones, when you look at the notes and the videos, they have their own like cost of debt, cost of equity, and so on. But if you're trying to find out the cost of capital, then you have to combine those two somehow. And normally we say weighted average because we are weighting on the market value. Weighted on the market value. So that's what normally work means. So it means that you need to know the cost of equity, you know the cost of debt, you know the market value of equity, market value of debt. Now, and also this is assuming that you have categories of equity and debt. And on that ground, you also have a formula you could use, which is the weighted average cost of capital. This one right here. Okay. And if you have only equity and debt, then you can use this formula. And of course, as I told you, these formulas are given to you, but you need to know what each of the terms mean before you can use it. Of course, here, this is the market value of equity, market value of debt, and the cost of equity, and then the cost of debt. But the cost of debt given to you here is before tax cost of debt, and therefore you have to account for the tax element, because when you pay interest on debt, it is deductible. So that is what weighted average cost of capital is. However, and this is what you normally find in the exam, like even what we are going to see today, is that the examiner will not give you just equity and debt as simple as that. They will give you this, but they will give you in different categories. Now, if we are to start looking at what we have in this question, they told us, because of course the equity is the share capital, okay? But it says it has ordinary shares and redeemable shares, which means that for equity, we have ordinary shares, then we have irredeemable shares. That's for equity. Then when we go for the debt, we have a loan note and a bank loan. So you see that we do have kind of four things, and therefore you can't just use the formula. Now, the good thing about this is that all you need to know for each of these ones is the cost of capital, which means cost of equity, cost of debt. Then you also need to know its market value. And then you can get your work. So for each of them, so what's the cost of equity? What's the cost of capital for our ordinary shares? Now the ordinary shares, they're saying it's 12 million worth of it, and they have a nominal value of 0.5 per share, ex-dividend market price of 7.07 per share, and come dividend market price of 7.52 per share. So now we need to understand what those things mean. When you say ex-dividend, it means after the dividends have been paid. And then when you see come dividend, it means before the dividend has been paid. Now, I normally give an example of a person who's selling his hen, and maybe this hen has already laid eggs, so that is ex-dividend. So when you are selling it, you are going to sell it at the value of the chicken without the eggs being considered. But if it's just about to lay eggs, then you want to sell and also put in the market value of those eggs, such that when you are selling the value of the chicken plus the value of the eggs that the person will get. So the difference between those two prices is basically the market value of the eggs. So if I get 7.07 and also 7.52, when I get the difference, what I'm going to get should be the dividend that has just been paid. So, and then they have also told us that in the previous years, this is what has been paid. So now, to get the market value, the cost of equity for a given company, we do have different formulas. Okay. The one that is mostly known by or the most common one is the capital asset pricing model. But of course here, this one requires you to have the risk-free rate and the market return and the asset beta and the beta of a company, or the equity beta. We don't have that information given to us. So which means that this formula won't work. However, we do have another one called the growth model, which talks about the price of a share, okay, which is given as the dividend that has just been given, 1 plus growth divided by the cost of equity minus the growth, which when you rearrange, you get the cost of equity. So this is what we are going to use. So we are going to use this formula, and now all we need to know is what we are going to put in the given elements that we have here. So for the cost of equity, we are going to need this formula. So first here, I just put this, but now I can now start really doing the calculation. Then I'll bring the values. So for the ordinary shares, what we need is the dividend that has just been given. We need the growth, and then we need the share price. Okay. So the dividend, as we said, we are going to get it from the difference between the ex-div and cum-div. So 7.52 minus 7.07. So that is the dividend that has just been given, 0.45. Now for the growth. Now, for the growth, when you are given this kind of data where they have given the dividends that have been paid for the previous years, then you can try to determine how much the growth has been. So how many years have passed? 1, 2, 3, and the fourth, okay, where this current one where we are in, where we have been given this dividend of 0.45. So in the previous year, they gave 0.43, the first year we have on record, and then, rather 0.37, because it's starting from, it's going 2003, 2004, 2005, 2006, and 2007. So now, 2003, they gave 0.37, and then 4 years later, they have given 0.45. So to get the growth, you get 0.45, divide it by 0.37, then to power 1 over the number of years that have passed. So remember, we have counted 4 years. We've counted this year, this one, and then the one we are in now. So that is 4 years. And then we subtract 1. So that gives us the growth, which is about 5%. Okay, 5%. Then the share price, we can try to determine the share price, is given to us as 0.5. This is the nominal value. Now, actually, this is not the share price, because this is the nominal value. Now, the share price is basically the value which is ex-div, okay? Ex-div, which is 7.07. So we can now get our RE, or the cost of equity, which is basically the dividend which has just been paid, multiplied by 1 plus the growth, divided by the share price, plus the growth. So when you add, you get around 11.7%. That's the cost of equity. So we can bring that, put it here. Market value of equity, we know that the share price is 7.07. But how many shares do we have? Remember, they have told us that this is 17 million and each one is 0.5. So if I want to know how many shares, I get 17 million divided by 0.5. So these are 34 million shares. But remember, I want the market value, so I multiply by 7.07. So market value is 240 million. Okay. Then we can now get the irredeemable shares. Now, yes, Jacent?
There is an additional information down there that the shares of TAF company consist of $12 million of ordinary shares and $5 million of redeemable preference
Yes.
shares.
Yes,
So
yes.
do we take the entire amount of 17, or we take the 12?
It's actually 12, not 17. Yeah, so it's 12. So we divide 12 here where I did the division. Thank you for picking that up. So we divide 12 by 0.5, multiply by 7.07. So that is 169 million. Okay. Then we can now determine for the irredeemable shares. Now, for the irredeemable shares kind of work like you'd find. Okay, remember shares have two types. We have redeemable and redeemable shares. If they are redeemable, it means that you kind of treat them like debt, because at the same even if they are shares, you get some dividends which are fixed every year, and then at the end of some period they buy them back. So they are redeemable, they are like debt. But if they're not redeemable, it means that they are equity. But what is going to be special about them is that they are going to be getting the same dividend forever. So they are like a perpetuity. To get the cost of perpetuity, basically you just divide the dividend by the share price. Okay. Now, what's the dividend that is going to be given on these shares? So they are having a nominal value of 0.5 and the next dividend market price of 0.31 per share. So, and they are 5% preference shares. So the dividend is basically going to be, so okay, we can actually do a working for them so that you don't cram everything in one slot. So for these ones, because they are redeemable, what we need, basically they use the same formula here, but because there's no growth, this one goes away and this one goes away. So it just remains this. Okay, so they use the same formula. So for them, all we need to know is what is the D naught and what is the P naught. So the D naught, as we have said, it's 5% of the nominal value. That's what they'll be giving. That's the dividend. And the P naught is the share price, which they have told us is 0.31 per share. Ex-dividend market price, 0.31. Therefore, the cost, I'm going to just say irredeemable, is going to be the D naught divided by the P naught, which gives us about 8.1%. So 8.1%. Then the market value, so this one, so because they are 5 million, and then the share price is 0.5, then the minimum value. So if I get 5 million, and I divide by 0.5, I get to know how many they are. So they are 10 million shares. Then I multiply them by the market value, which is 0.31. Okay, so we have finished the equity. So let's go to the debt. Now, the debt has the bank loan, and it also has the redeemable debt, okay, which is the loan notes. So the loan notes have a nominal value of 100 per loan note and the market price of 102.34 per loan note. And annual interest has just been paid, and the loan notes are redeemed in 4 years' time at 5% premium to nominal value. So interest has just been paid, which means that this value that has been given to us here is X int. Okay, for debt, because we are paying interest, it is X int, not X div. But they basically mean the same thing. X int, interest has just been paid. Cum int, interest has not yet been paid. It is yet to be paid. So now when you want to find the cost of debt for redeemable shares, basically you want to find the internal rate of return. So what you do, you set up your working. So this is year, so year 0. So we have the cash flow here. So for year 0, it's the market value, which is 102.34. That's year 0. Let me just arrange it a little bit. So year 0 goes here, put cash flow here. So that is the cash flow. Then now for years, because it is in 4 years' time. So year 1 to 4, there's interest, and the interest is 7%. So ideally it should be 7, but we are trying to get the one of after tax. So you have to subtract the tax, which is 30%. So basically it becomes 4.9. Then in year 4, there is redemption. So they are saying redemption is in 4 years' time at a 5% premium. So instead of getting 100, you basically get 100 multiplied by 1.05, okay, at a premium. So you get 105. So these are our cash flows. So from there, we can now say discount factor at, now normally I start with 10%, okay, and then from there, that's when I choose what else to do, but I start from 10%. So discount factor, if you don't know, the formula is given to you in the tables. Okay, this is the present value table, and then the formula is here, 1 plus r power minus n for a simple discount factor, or 1 minus 1 plus r power minus n over r for an annuity. So this one here, of course, is 1, year 0. So year 1 to 4, we are using an annuity. So to be 1 minus 1 plus 10% power minus 4. Okay. Divide by 10%. So that is 3.16. And if you want, you can see it here in the tables at 10% for 4 years. 3.170. When if you round this one off, you get that, okay? So you can, for annuities, it's okay to go to the tables and pick it real fast. But if you become good at the formula, it is better. So then you can now get this one for year 4. This is a simple discount rate of 1 plus 10% power minus 4, which becomes 0.68. Okay. Then you can now get present value at 10%, which is basically the product of the cash flow. And I'm going to fix the cash flow. Multiply by the discount factor 10%, which you can drag, and then you get the NPV. So now you can see that it's negative. Therefore, I'm going to put the second one at 5%. If I had got positive, then I would increase it to 15%. But now I'm going to try 5%. Now the beauty with this is that I can copy this whole thing, put it here, and just change this one to 5%. Okay, so I can now find the present value, and I can just copy this. So present value at 5%. So I can check that formula is still working. So at 5%, it's giving me 1.4. Okay, so it's giving me a positive. So now I need to find the internal rate of return. So internal rate of return, I can just go and find out the formula here. You need to know this one. They don't give it to you in the exam. So just to put it in so that you can see it, and maybe remember how to, like, just have a way of remembering it. So there are so many of them, but the one I'm looking for is right here. Okay, and it basically says that to get IRR, you get NPV at point A, which is A is the lower discount rate, divide by NPV at A minus NPV at B, multiply by the rate at B minus rate at A. Basically, what it means here is that you're going to say NPV at the lower discount rate, which is 5%, divide by NPV at 5% minus NPV at 10%, okay? Multiply by 10% minus 5%. So which gives us let me just confirm if I've not. NPV at 10%. Divided by NPV, multiplied by 10% minus 5%. Okay. Just confirm whether we did our computation right at 10%. Okay, that's okay. Then at 5%. Okay. Okay, so that is correct. So let's NPV at 5% divided by NPV at 5% minus NPV at 10% multiplied by 10% minus 5%. Yes, Jacent.
You missed out on adding the lower rate.
Yeah. Oh yeah.
Yes.
We start with the lower rate.
Yes.
I was not seeing it again. So we start with the lower rate, which is 5%. So 5% plus, okay? So that gives us 5.43% as the internal rate of return. So that becomes the cost of the loan notes, 5.43%. So you can come and put them there. Now, what about the market value of the loan notes? Now for those ones, for the loan notes, they have a nominal value of 100 per loan note, but market value is 102.34. So we just need to know how many loan notes we have. So it's 10 million. So 10 million loan notes, that means if each one is 100, so you can first divide 10 million by 100. That gives you about 100,000 loan notes. Oh, supposed to be here. Then I multiply by market value, which is 102.34. That means I have 10.234 in market value terms. And then what I have now left is the bank, the bank. Okay. Now for the bank, they said it has the banknote has variable interest rate. Okay. So now for the bank loan, if it has variable interest rate, it means that the market value kind of reflects what the value is in the books. If somebody were to usually for banknotes, sometimes you may need to find its market value, but most cases you find that the questions don't give you enough information to do so. So what we are going to just say is that the bank has a market value of 3 million. So we shall come and put here market value of 3 million. But what about its cost? Okay, because they are saying that it has variable interest rate. So which is its cost? So what we can assume, okay, and this one you can put it as an assumption, is that it shares the same cost of debt as the loan notes. Okay. So once you do that, then you have everything you need. And basically to find work, we said it's weighted average cost of capital. So what we do is that we just multiply cost by the market value. So by the market value. Okay. And then we finally just add this. So that is 20. So remember, we are getting weighted average cost of capital. So we are weighting by the market value. So we also add this. Okay, now to get the work, you basically divide this by the market value, which gives us about 11.2%. That's the work. Okay, now I know the formula which is given to you in the exam has only equity and debt, and now that we had four things, you couldn't use it. So, but remember the concept of weighted average is that basically you just multiply by whatever you are weighting with. So you are multiplying the cost of capital by the market value because this is what we are weighting with. Then you sum up the product and divide by the total weight. So that is weighted average cost of capital. Now I am sure that if you have done this kind of question before, you know, of course, how to arrange your information so that you put in the values as you get them. Okay, that means that it will make you move faster. So I don't know if you guys have a question on this before we move on.
Yes, Jason has one here.
Yes, Jason.
What's the implication of using the work formula here?
This one here.
Yes, what's the implication?
Now, this one only works if you know the value of equity and the cost of equity together,
Okay, okay.
and also debt and also the same. But so since we have here many things, you don't know what will you put in value of equity and cost of equity because you have two of them. So
So,
yeah.
what happens in case I have one, I know the value of equity. Equity had only one thing, one
Yeah.
item,
Yes.
but the value of debt has so many items. Do I still use
You
it
still
for
do
like,
this way.
okay.
As long as you have anything that is not one, okay, yeah, you have to use this method. And in most cases, for section B numbers, you'll find that this formula applies because they'll give you information that you just plug it in. But for section C, most cases, they'll give you more items such that you have to find yourself doing this method like this. Okay.
Okay, the other question
Mm.
is how do you treat the cost of a bank loan in case we have an interest rate given?
So for the bank loan, we shall see. Sometimes they can give it to you because remember a bank loan also can be payable like through amortization.
Yes.
You know that's what happens with most bank loans. They give you the money, then they tell you are going to be paying this much interest, and then you amortize over the years given. So you find that there is a working that you can do for amortization that gives you the cost of debt. So there is that, but most cases what they do, they give you either a single interest rate that you can use, or they don't give you one at all, like here, so that you use the loan notes one or you amortize. I'm sure there's a question that is either something that we find later on or something that I've already done, which has where there's amortization. I'm going to find out which it is so that I can let you know the alternative to dealing with them. So the other part is for circumstances under which you can use the current work. So now you can see what we have done with this formula is that we have weighted based on the gearing. Because when you look at this part of data and date price, this is gearing. So when should you use the current work for the new project? One, when the project gearing or when the project financing is not going to change the current gearing. So basically what I mean is that if debt is 50%, before I invest, when I invest, I should also still have 50% debt. That means that the gearing has not changed. The other one is that when the project risk is the same as the business risk, because the cost of equity and the cost of debt depend on the risk of the business, especially for the cost of equity, because as you know, this is determined by the shareholders and how they perceive of the risk that you are of the business. And there is also the capital pricing model, which talks about how risky your business is compared to the market. So if that is going to change, then you can't use the current work. Okay, so those are the two situations. They said discuss circumstances under which, so you would list it, you would not just list them here. Okay, you explain when the project finance is not going to change the current gearing of the company because the work is computed based on the gearing of the level of equity and debt in a company. That's what we are waiting with. And also when the project risk is the same as the business risk, because that means that now the company's risk is not going to change because the capital providers might ask for more money, okay, the more risky the business is. So those are the two situations. So now, the last part of the question is the advantages of using convertible loan notes as a source of long-term finance. So what we need first of all know what is convertible loan notes. Now these loan notes that are convertible, it means that they are a hybrid instrument because they are debt which could be converted to a predetermined number of shares at a predetermined date. Imagine I give you loan notes, you give me money, and I tell you that after 4 years, you can either get back your money or you can convert those loan notes into 50 shares. So that means that those are convertible loan notes. And why is it good for you to have convertible loan notes? First of all, for Tufa, they are usually cheaper than normal loan notes. Or basically, we are saying Tufa can give a lower interest rate than the normal loan notes because since you can convert them to equity, they have that inherent value in them in that you are willing to accept a lower interest rate because if the company does well, then the share price will increase and you have benefited if you convert. So that is one thing. Also, if they convert, then Tufa would save on cash outflow. They convert because it means you don't have to pay them money, but rather you basically just give them shares, okay, without giving them money. Okay? And therefore, the other thing is that they can kind of moderate on the gearing. And how do they do that? They would increase the debt capacity of Tufa. And why does that happen? Because when you convert, gearing reduces, and thus you can have capacity to borrow more later on. So that is also something good about them. But that's not only what happens. Okay. The reason why it happens is that whereas the debt is distinguished, but equity increases. So they have kind of a double effect. Because normal debt also, when you pay it, gearing reduces, but equity doesn't increase. But for redeemable debt, when you convert them to equity, gearing reduces substantially, then you can give yourself a chance to borrow more money. And other things, like investors like them. Okay, why do they like them? They have an upside. The company performs well. So they are easier for you to actually sell than the normal debt. So that is it for this question. And let's see. Okay, let us also do this question. Tin Co. I don't know if I have not done this before, but it's okay. Before we move on, please don't forget to look at the examiner's reports on this question when you go to the Kaplan kit, so that you see where mistakes were made and which mistakes to avoid. Okay, so Tin Co. So Tin Co, they are telling us to calculate the theoretical X-right price per share, which when you know it, you can calculate it very fast. That's why it's only 2 marks. Then assuming equity financing is issued, calculate the revised earnings per share after the business expansion. Then assuming debt finance is issued, calculate the revised earnings per share after business expansion. Then revised share price under both financing methods after the business expansion. And evaluate whether equity finance or debt finance should be used for the planned business expansion, which is also a very good 14 marks. And then also discuss Islamic finance sources as alternatives to rights issue or a loan note issue. So let us go and look at what they are saying. So Tin is planning an expansion of the business operations, which will increase profit before interest and tax by 20%. Company is considering whether to use equity or debt finance to raise the 2 million needed by the business expansion. If they use equity finance, then they will have a 1-for-5 rights issue at 20% discount to the current ex-dividend share price of 0.5 or 5 per share. Nominal value is $1. They do debt, then they issue 20,000 8% loan notes, nominal value 100 per loan note. And then they give us the financials here. So let's first leave the financials. We shall look at them. But key that we have these 7% loan notes that we already have. The current price earnings ratio is 12.5 times. tax is 22%. Debt equity ratio of companies that are similar is 60.5, and average interest cover is 9 times of those companies. Whenever they give you companies that are comparable, it means that you have to compare what we calculate with that. And then we figure out how to deal with it. So what we need is the theoretical extract price. Now, theoretical extract price now. Basically, with this, when you offer what we call a rights issue, okay? Basically, you are offering it to the existing shareholders to buy more shares in a company, okay? And why do you offer this to the shareholders? Basically, what you want to do is because when you sell shares to the public, you have to get a broker, somebody has to market for you and all that, so it is more expensive. But if you go to your current shareholders and you tell them to bring more money, then it's easier. But also they don't like diluting their shareholding by you going out there and people coming to buy shares. They prefer you first talk to them, and only when they don't want to buy shares should you go out to the public to get more. So we are offering, for this, we are offering a 1-for-5 rights issue, which means that for five shares, which cost how much? So we need to know how much is the market value of the share before. So to get that, let us see. We have the price earnings ratio. So since we have the price earnings ratio, we can get the share price. So, but let's see if we have that figure already. Yes, the current share price is $5. So if it's $5, means that is 5 times 5, which is 25. And we are going to give 1 share. And that share that we are going to give is at a 20% discount to 5. So we are going to give it at 5 multiplied by 0.8. So at 4. So which means that we shall have 1 times this. Which means that I have 5 shares here.
Excuse me, how
Yes.
did we get the 4 for the 1 share, the price of $4?
At 20% discount to the current ex-dividend price. So if it's 20% discount, means that you multiply 80% of the 5, that's what you remain with. Yes. So we have 5 shares at 29, which means that to get the theoretical extract price, basically you just get this one divided by 5, which gives you, oh no, we have 6 shares, not 5, because we had 5 and then 1 share, that is 6 shares here. So divide it by 6. So, which gives us 4.8. Okay, 4.8, here's the theoretical strike price. So, is that part clear?
Yes.
Okay. Now they ask us to assume that equity is issued. What's the revised earnings per share after the business expansion? So, now, here we have to look at these financials. What is going to change if we issue shares? Okay. Now, if we issue shares, are we going to, because remember why we are issuing, why we are doing this is that the expansion will increase profit before tax by 20%. Okay. And we are going to raise 2 million for that expansion. So it means that if we start from this line of PBIT, there shall be increase. Okay, so we can actually come and set up here. So if we are doing the equity finance. So since they are working in thousands, so let's also work in thousands. So we have increased PBIT. It was 1597, but it will grow by 20%. So it will become 1916. Now, so yeah, yeah. Does anyone asking?
Looks like Jacinth has a question.
Jacinth, you have a question? Not? Okay, I don't know. I have a problem hearing what you're saying. Okay. If you can hear us properly and you don't mind, you can type it. I'll see it, then I'll read it. Okay. So what comes next is interest. So interest, if we issue equity shares, we are not going to have any change in our interest costs. So that is going to be the same. So from here, we can actually get to that point. So this is the PBIT. Then from there, what comes next is taxation. Now taxation, they say 22%. So we have a taxation. Okay, so this is profit after tax. Okay, so before it was 1,000, now it has become 1,249. Remember what they want us to do in this question is that we need to get the revised earnings per share. So now this is the profit after tax, which is the earnings. So we need to know the shares. Now the shares, we had 500. We had 2.5 million, but these shares were valued at 5. Okay, but they had a nominal value. Do you have that figure? No, we don't have the nominal value. But I remember seeing it, unless I'm remembering wrong. Yeah, we have $1. So since nominal value is $1, it means that we actually have 2.5 million shares. But now we are giving 5 for every new share, right? So it means that the new shares are going to be 2.5 million. Okay. Then multiply by 5 for 1 for every 5. Okay. Then plus 2.5 million. So they become 3 million shares. So now we can get the earnings per share. We are working in millions, so let us remove some zeros here. So now we can get the EPS by dividing the earnings by the price. I mean by the shares. So that becomes 0.42. Now, what is comparable? They told us, of course, this is not where I should bring this up, but we know that it's coming. So we can just bring here the comparable one. Comparable companies have a debt-to-equity ratio of 60% and average interest cover of 9 times. So not yet. Okay. Let us first leave that. So that is earning per share if equity is used. Now, what about if debt is used? That's the third part. So for debt finance, again, we can just borrow this. So of course, the increased earning is the same, 20% growth, but the finance cost, okay, the finance cost is not going to be just 315. Because if we offer debt, then we shall issue 20,000 8% loan notes with a nominal value of 100 per loan note. Now, they have not told us anything about these loan notes being redeemable. So we are going to assume that they are irredeemable. You understand? We are going to assume that they are irredeemable. But even that may not be something that we need to assume, because what I just need to know is that how much interest am I going to pay on this? So now 8%. So now if I'm going to pay 8%, remember I have 20,000 notes multiplied by market value of 100 multiplied by 8%. Okay, which gives me 160,000, right? But here we're working in thousands, so we are just going to add 160. So it becomes 475. And then the post before tax becomes 1441. Taxation, that's okay. So this is now the PRT. Now the shares, are going to remain 2.5 because we didn't issue shares. So now we get 0.45 as the earnings per share. So it seems like it's better to use debt financing. Okay, it seems like, but we need to first of all understand what has happened to the debt to equity ratio. Okay, and they have given this on book value terms, so we don't have to do any computation for market values. And then interest cover of 9 times. So let's calculate interest cover. Now, do you know how to calculate interest cover? Interest cover is got as PBIT divided by the interest costs. Okay, so this becomes 6.08 if we are using equity financing, and the comparable supposed to be about 9 times. So here we are not doing so well. And then also debt to equity. Debt to equity, so the debt in here, we already have 4.5 divided by the equity. Now the equity in this case we have to add we need to know how they got that debt equity before, because sometimes you get the debt divided by the ordinary shares, but perhaps they are using also the retained earnings. So we can actually first, what we are going to do, we are going to use the retained earnings, okay, as well. So we are going to have 4,500 divided by 2,500 plus 5,488. But that is if we didn't have the new share. Remember, when you do equity finance, so we shall actually now add, there will be change in our equity. So we are going to have to figure that out. So, and that is going to be the money that we are raising, the 2 million. So what we are going to do, we are going to say divide by 4,500 plus 4,588 plus 2,500 plus the 2 million. So that's about 33.1%. But what's the comparable? 60.5. So when we do debt equity, here we are good when we are doing equity finance. Then we do the same computation, but for debt financing. So interest cover is going to be, in this case, 4.03. So we are really doing not so well here. Then for debt to equity, we are just going to have to remove this 2 million and add it to this one here. That becomes 56 point. So we are still doing good, okay? Although we are doing much better for this side. So that is the comparison. But what they want us to do is the revised share price under both financing methods after business expansion. So, revised share price. So we have the equity one, the debt issue. Now, revised share price, we know that the current PE ratio is 12.5 times. Now that we have the PE ratio and we already have the EPS, remember that to get the share price, you just get the PE ratio and multiply by the EPS. So we have 12.5 multiplied by the EPS. Same thing here. Okay. So this is what we have. And now they're telling us to now use the calculations to evaluate whether equity or debt finance should be used for planned business expansion. Now, like I told you here, you can see that the interest cover is very diminished. Okay, first of all, for both of them, it is less than the ideal of 9 times. But now this is very diminished when we are using debt finance. However, the EPS is higher for debt finance. So now it becomes, how are you going to advise, right? So the advice here usually depends on what you think is most important. Okay, is it important for interest cover to be low or high? Because interest cover being low means that you are at a risk of not being able to pay your interest. So your business risk is increasing. But the EPS tells you that for each share of the shareholders, you are getting them more money. And people want more money. So shareholders usually prefer debt because equity is more expensive. Okay? Now, so what do you think? What do you think you'd advise? So the advice would be that it depends on the risk appetite of the company. If the company can stand having low interest cover and satisfy the shareholders, then they should do debt financing. Okay. However, if they would prefer to be safer regarding interest payments, then they should do equity financing, but the earning per share is reduced, and therefore the shareholders have kind of lost value. Okay, you can leave it at that. Any questions before we do the second part? No? Okay. So the second part is about Islamic finance. Now, Islamic finance is one of those topics which, not to bias you, I never used to like. So I will use today's session to basically kind of explain the types of Islamic finance that you can find. So Islamic finance, this is where these are questions that actually I've covered it in the past, but okay, not only Islamic finance, this is just the entire chapter. But what you need to know about Islamic finance is that, first of all, they don't allow what we call riba. And riba is basically the normal interest that we have been calculating. So they don't allow that because Islamic finance tries to award risk. So if a bank just gives you money and then you go and you are the one to suffer all the risk, then they don't see why you should give them interest. So they advocate that you, as a bank, should have some involvement in the business somehow. So this is what they start as the underlying principle. And also the fact is that cash should not be used for things that are treated as haram. Things you can't like open up a piggery, you can't open up a bar with the money that you get from this kind of financing. So what you're supposed to do with this money is supposed to be doing something that is considered haram. And there are categories of Islamic finance, and the way you should understand them is to compare them to the normal instruments that we have. So in this question, they had asked us to look for ones that resemble, if I'm to go back, they had asked us to discuss two that can be considered that alternatives to rights issue or a loan notes issue. Remember that a rights issue is like equity, and this is debt. So they want you to find the Islamic finance instruments that are similar to equity or debt. And you can see them here. There is a murabaha, which is like trade credit. There's a sukuk, which is debt finance. And then there's mudaraba, which is equity finance. So those are the ones that look a bit like equity or debt. Now, there is a technical article which goes into detail to explain this, but you don't need to have a very big explanation. You just need to know how they resemble. So Ijara looks like lease, Sukuk looks like debt finance, Mudaraba looks like equity finance, and Musharaka looks like venture capital, and Murahaba looks like trade credit. And you just need to know how to simply explain them. So if I go to the textbook where they give you more information about them, so okay, so here they are. So Mudaraba, as we said, or Murabaha, let's start with Murabaha, is like a form of trade credit or a loan. So, but here, with the Murahaba, the bank takes constructive or physical ownership of the asset. So you go to the bank, you tell them, I want to build something. So they give you money, but then they own that asset. Then they sell it to you for a profit. Okay? And then you they tell you to pay over a given number of installments. So they don't want to call the interest, they call it a profit. But the difference is that if the bank owns that asset, during that time when you are still paying, that asset is still on their books until you finish paying it, and therefore the asset comes to your books. So in the normal accounting, you do have your asset as yours, and then you just have a bank loan in your financials. So that is murabaha. It's like you have taken out, it's like a loan, but the bank actually takes possession of your asset and then you sells it to you at a profit. Then ijara, on the other hand, is like lease finance. So where you use the underlying asset or a service for consideration. So here, the bank gives you the asset, like the plant or office automation or anything like that. And then you keep paying them a fixed amount for a fixed period of time. So it's like they have leased you an asset. And this one also has the issue about the being a finance lease or operational lease, but we don't want to go into that detail with this. Just know that ijara is like a lease. The bank gives you underlying asset and then you pay them a fixed amount of money for a fixed period of time. And after that time, you can take ownership of that asset. Or the asset can remain with the bank, depending on the type of lease that has been taken. Then on the other side, we have what we call sukuk. And sukuk is like sort of like an instrument where we say, because remember we said here that for sukuk, it's like debt finance. So you give a loan note, which is the instrument that we are referring to here. But that doesn't give you the voting right and also profit before distribution. So it's just like normal debt. But also it includes interest-based elements. Now, with sukuk, we don't have all of these things in there. Instead, the Islamic bonds, which is called sukuk, they are linked to an underlying asset. So the bank becomes part owner of that asset. And then whatever profit is made is what you share with the bank. Okay? So like the sukuk owner can participate in the ownership of the company and they can get profits. But also if there are losses, they also equally bear them. That's for sukuk. And then mudaraba is like partnership, which we are calling venture capitalism, where somebody gives you money, okay, which is the bank in this case, and then the other one brings the enterprise knowledge. So they give you money, but for you now work. So then the contract itself is a profit sharing contract. So I give you my money, all of it, and for you do the work, then we share the profit. But I don't take the loss. Me who is doing the work, I don't take the loss. The loss is only taken by the person who gave the money. The idea is the person who gave you the money is not doing any work, doesn't take any risks, so should only benefit from the profits. But if the losses come, they should take them all on, which is not the same thing with the bank. When the bank gives you money, they expect you to give them interest, even if you don't make profits. And then we have a musharaka. So it is also a relationship like a venture capital. But here, we don't have just one person bringing the money. Here, two people bring the money. So like a partnership, really. So you bring money and then you agree on how you divide the profit and losses. Okay? And here they're saying pro rata, but it can be different. Pro rata means that according to what you brought, but sometimes they end up agreeing different contributions and then they can use that. So it's like venture capitalism. So all of them are entitled to participate, but they are not required to do so. So the profit is agreed, but the loss is borne according to the proportion that they each contributed. So these are the different kinds of Islamic finance instruments. So you just need to know them such that in case a question were to come, like this one did, you are able to get these 6 marks. Okay, remember, we don't want to spot in ACCA, so any topic that you find, even if it's difficult, you need to still give it your best so that you can get a chance. Okay, if it comes, you are able to give it something, and basically you end up on a good side of that, right? So I hope that is clear for us. Do we
Yes,
have
it is.
Okay, do you have any questions?
I don't.
Okay. All right. So now what I would advise is to, of course, go to this and look at other questions that are within this section. Go through them, and then you basically understand what other types of questions will be asked under this section of business finance. Okay. It's under business finance and cost of capital. So that you look at the cost of work and then a capital pricing model and the like. Maybe tomorrow we shall do 2 more questions from here, so that you get better at it, and then I'll leave you to look at the rest of the questions yourself. I have sent a document, or rather a link in the group for you to fill in the papers that you're going to do. So if you haven't filled, please do so, just for us to be able to track some of which people are doing which papers, so that we can be able to assist you. So thank you very much, and see you tomorrow.
See you tomorrow. Thank you.